Hello and welcome to a special Echo45 Advisors Market and Economic Update. In this video, we'll discuss President Trump's tariff announcements and the immediate market reaction. The April 2nd tariff announcement rattled markets as investors worry about how new trade barriers and escalating tensions will affect economic growth. Over the next few minutes, we'll provide perspective on what happened and dive into how trade policy can have ripple effects through the economy and the markets. In the first chart we'll look at, you can see some of the new reciprocal tariffs imposed against specific countries. These tariffs are referred to as reciprocal since they are based on tariff levels each country imposes on U.S. goods, in addition to our trade deficits with each country. These numbers include the base 10% tariff that is being applied to all trading partners. The new tariffs include 34% on China, 20% on the EU, and 25% on all imported automobiles. These tariffs are also in addition to those already in place. So in the case of China, the actual tariff level would be 54%. Canada and Mexico remain subject to previously announced 25% tariffs related to immigration and fentanyl concerns. These latest moves show that the administration is resolved to make significant changes, but even these could be negotiated with each country over time, as they were during the first Trump administration. Next, this chart shows that economic policy uncertainty has increased due to tariffs, taxes, and other policies. While there are many arguments for and against tariffs, markets fear that tariffs could raise consumer prices as businesses pass on these costs. When it comes to company earnings, current projections for 2025 growth have been reduced from 14.2% to 11.5%, with further reductions expected as tariffs raise costs and lower profit margins. Which sectors are likely to be impacted the most? Sectors with significant international exposure, including information technology, materials, consumer staples, consumer services, and energy, will likely face the greatest impacts from tariffs and potential retaliatory measures. Finally, it is important to acknowledge the current market reaction. When we look across history, many events have caused concerns among investors over the past century. During these times, it may feel as if markets will never stabilize. And yet, markets have performed very well over the past century despite wars, pandemics, recessions, political change, and more. This chart tracks the S&P 500 going back to the Great Depression. As you can see, the stock market is resilient in the long run, even if it may feel fragile in the short run. Market downturns naturally feel concerning, but maintaining a long-term perspective has historically been the most effective approach to achieving financial goals. Investors should focus on controlling what they can, recognizing that uncertainty is a constant presence in financial markets. Yet history demonstrates investors can still succeed amid such uncertainty. We hope you found this special update helpful. If you would like to discuss these topics in more detail or explore how they affect your personal financial plans, please don't hesitate to reach out. We look forward to speaking with you.